Hey everyone, we all know investing is pretty much the absolute best ticket to building real wealth, right? But honestly, how many of us actually understand the exact mechanical engines powering it underneath the hood? Today, in this explainer, we're tearing down the engine. We're going to dissect the foundational building blocks that the ultra-wealthy use to literally multiply their fortunes. Get ready, because it's pretty fascinating.
Okay, let's dive into this roadmap. We'll kick things off with the core of investing, then we'll compare stocks versus bonds, explore the different types of investment funds, look at the immense value of time, and finally, we'll wrap up by mastering compound interest.
Section 1. The core of investing.
So before we even talk about building wealth, we've got to look at how capital actually moves around. Investment isn't just, saving pennies in a jar. It's the active redirection of resources from what you're consuming today to create a much bigger benefit in the future. Think of it like putting your assets on the payroll. Actually, that is the fundamental secret to how the wealthiest individuals got there. They didn't just stuff cash under our mattress, right? They actively put their money to work to earn a profit.
And that concept, it builds out into this massive living ecosystem of capital. It's a three-step dance. First, you have savers who effectively lend out their extra funds. Then financial intermediaries, think banks and brokerages, step in to act as the bridge. They link the parties and funnel that money directly to the third group, borrowers who actually utilize the money to build things. It's this continuous flowing loop that literally keeps the entire economy breathing.
Moving right along to Section 2, Stocks versus Bonds.
Okay, now that we understand that ecosystem, what are people actually buying? Well, let's look at stocks. When you buy a stock, you are buying a true slice of ownership in a business, and that pays out in two distinct ways. First, you've got dividends. That's your quarterly slice of the company's profits just for holding the stock. And second, you have capital gains. That is simply the profit you make when you sell your piece of the pie for more than your original purchase price. Buy low, sell high. You know the drill.
This brilliantly illustrates the big divide in investing. While stocks give you true ownership in a public company, which brings higher risk and those crazy, unpredictable price swings, bonds are totally different. They're essentially just IOUs issued by corporations or governments. With a bond, you aren't buying ownership. You're playing the bank. You're loaning them money in exchange for a guaranteed payout in the future. And that guarantee, that brings some much-needed stability to a portfolio.
To really get bonds, you have to know they are built on three precise components. First is the coupon rate. That's just a fancy term for the interest paid to you, the holder. Then there's the maturity date, which is simply the exact date when the final bill comes due. And finally, the par value, which is the specific flat amount you're paid back at maturity. It's a strictly mathematically predictable timeline.
All right, Section 3, Types of Investment Funds.
So how do we practically buy these core assets? Well, we usually go through intermediaries. Let's look at three big ones. Mutual funds pool money from everyday savers to buy a massive, diverse basket of stocks and bonds, which naturally dilutes your risk. Hedge funds, they do kind of the exact opposite. They're private funds using highly aggressive, exclusive strategies, mostly for ultra-wealthy investors. And then you have pension funds, which take employer deposits and invest them to build a really stable, long-term income bridge for retirees.
Which brings us to Section 4, the value of time.
Beyond diversification, there is an ultimate advantage in investing, and it's time. I love this saying, you make more money on the money your money already makes. Time is, without a doubt, your single greatest asset as an investor. It's like a snowball rolling down a hill. The longer your capital sits invested in securities, the more it exponentially multiplies itself.
And that perfectly sets up Section 5, Mastering Compound Interest.
Now, what's really interesting about this slide is seeing the true mathematical engine of wealth side by side. Simple interest is totally linear. It calculates interest solely on your original principal amount. But compound interest, wow, it calculates interest on the principal and on the accumulated interest. It is literally interest on top of interest. This creates this incredible exponential growth curve that aggressively maximizes the growth of your wealth over time.
Okay, let's ground these abstract mathematical formulas into a highly relatable real-world scenario. Imagine you loan a friend $10,000, and they agree to pay it back in exactly 5 years, assuming they actually pay you back, of course. Let's see how the underlying math completely changes the outcome of this exact same loan.
Let's walk through the numbers. If your friend repays you using a simple annual interest rate of 5%, you earn $2,500 in interest over those 5 years, so a total repayment of $12,500. Not bad, right? But if you ensure the interest is compounded monthly, 12 times a year, on that exact same $10,000 loan, your interest earned jumps to over $2,800. The total repaid is now pushing nearly $13,000. Keep in mind, the timeline and the 5% rate were completely identical in both scenarios. So the crucial point is this final number, $12,833.59. That extra chunk of cash was generated purely by the mechanics of compound interest working in your favor. It wasn't extra work on your part, it wasn't extra time, it was literally just superior math doing the heavy lifting. As you've seen today, every investment requires you to balance risk against your expected reward. But what happens when you flip this math upside down? What happens when you use the absolutely riskiest way to borrow money, credit cards? Well, that is a dangerous game of compound interest working against you instead of for you. And honestly, it's exactly what you'll need to uncover next time if you truly want to protect the wealth you're building. See you then.